Welcome to Old Fashioned Finance, the podcast that mixes cocktails and high finance. I'm your host, Caleb Frankert, and I'm joined by my good friend and fellow money muddler, Jason Burnell.
Caleb, can a podcast about finance be entertaining?
Not without alcohol.
All right, let's mix it up.
Woo!
Yeah. Dude, this is cool.
Yeah.
We're standing at a bar.
We are. New bar.
New bar.
Nice.
Nice.
If you're listening, you can tell that we are standing behind our new bar because we just told you we were. It's weird because you seem really far away.
Yeah.
The way we're sitting right now.
Yeah, well, we don't have it all the kinks worked out yet.
The microphone setup is not totally set.
Yeah.
But
that's okay. So we got a used bar for our office. It's kind of cool.
It's very cool.
Gives us a place to store we have like 3 bottles of liquor to store in it.
Yeah. Like 300 bottles. Yeah.
Yeah, so it's kind of cool that we have a more official place other than a stupid IKEA table.
Yeah, we graduated college, so we're done with IKEA. You know, if you are listening to the podcast and you're in our area, pop in and check out the bar. It is conducive to making drinks. This is the first one that we've made in the podcast studio.
It was kind of cool, wasn't it?
It was very cool. Got a little dry sink area, I guess you would call that.
Sure.
Throw some ice in there, mix your drinks up. Yeah, it's cool. It feels different.
It does.
I feel like we're echoing more in here.
Yeah.
There's not as much stuff to bounce off of.
Yeah, well, we can fix that. We just need to move all our crap in here.
Yeah. So we are going to talk about finance today.
Oh, yeah.
And we're going to drink. Definitely going to do that. Because a podcast without alcohol can't be interesting.
It can't be.
Well, not if finance is involved anyway. All right. So, Jason, this is interesting because we just ran a slew of meetings over the last couple of weeks.
Oh, gosh, yes.
We're still tired from it in good ways, I think.
Yeah.
But you had a lot of questions regarding this week's topic, didn't you?
I-bonds.
Bonds. I-bonds. Yeah. We did this once.
Not exactly this
No,
topic.
not this one, but we did do a James Bond theme. I don't know why, but we just, we're talking about bonds. I-bonds.
Yeah.
The Sean Connery impressions have come out this week.
Yeah. I mean, I'm not very good. I am not even in the same universe as cool as that guy. So
No.
I mean,
definitely not. You're way not cooler than him.
Thanks, buddy. No, I mean, I think demand for these things have been, through the roof. So
if you're not tracking yet with us and you're going I-bonds, I don't know what that is. Stay tuned. We're going to do a lot of explaining.
Yes.
Jason had a few clients say, "Hey, what about I-bonds right now?" And it's funny because you said something after a meeting. You said, "Hey, have you given any thought to I-bonds?" And I go, "What? Why would we do that?"
Right.
And then, okay, now I can see why, digging into it a little bit. So it's good. Meetings with our clients sharpen us, definitely.
Sure.
But I thought that, and you thought, really, heck, we could do a podcast on this. We could go into really, what are they? How do they work? Is this worth looking into, Jason? Because it's something that's not talked about very often.
Yeah, and I think it is. I think it's worth looking into. And, again, that demand because of how they're structured in our current inflationary world, it's an important place to look right now.
Yeah, something that's been ignored for a long time.
Definitely.
Maybe we're diving too far into the finance topic
I need
at
a
this
drink,
point
man.
because we need to try this out. Yeah, so we're going down that trail again. We're talking about, well, when we say Bond, we have to do the James Bond theme. This is not GoldenEye. We did that one a long time ago. And we drank dry martinis, right?
Yep.
So today, this is a spin on a dry martini, but we're drinking what's called a Vesper. This is actually the drink that James Bond drank in the first movie.
Right.
The first book, Dr. No, right?
Mm-hmm.
The name Vesper.
They brought it back in the movies.
They did. The Daniel Craig you were just watching when I walked in the room. That's
we were being
funny.
inspired.
But they were going back to some lines in the original book, the Ian Fleming novel, right? So there wasn't a dry martini, and I think I can't really go way back and think about all that we said in that episode 2. But what he was drinking in the movies was not actually a dry martini. He was drinking a Vesper, and we call it a Vesper because of the first Bond girl. Yeah, so this is a little bit different. Daniel Craig just rattled off the recipe. Let's dive into this, Jason. This is a stout drink, by the way.
Yeah, I mean, you got to put your big boy pants on for this one.
So 3 ounces of gin. All right.
I mean, that's a lot right there.
Oh, yeah, absolutely. That'll sneak up on you quick.
I mean, gin is just used to get drunk, I think, sometimes.
I want to think of a, what's the quote from Ron Swanson. Yeah.
Yeah.
Clear liquors are for rich white women who want to get drunk. I think I said that right.
Okay.
All right. So anyway, 3 ounces of gin. We used Nolit's dry gin, so we've switched it up a little bit. I think it should go good in this cocktail.
I think that's probably one of my favorites.
It's a more herbal, florally tasting gin.
Yeah, it is.
We've got vodka in here too, guys. You know how we feel about vodka if you've listened to us. But we are staying true to the original recipe. So 1 ounce of vodka, we're using Tito's because it's not as horrible.
It's
American. And then this, I'm really excited to try this. A half an ounce of Lillet Blanc, which is, you were trying to pronounce this word. It's a what, Jason?
It's a...
Starts with an A.
I have no idea.
Aperitif?
Ooh. Oh, man. Pascal's going to throw us under the bus. Sorry, buddy.
Oh, yeah.
We have a wonderful French friend, and he's just going to laugh in our faces.
I make fun of how he mispronounces words all the time, like champagne. It's really funny.
It is.
So anyway, this is one that I haven't been able to find, and here we found it today, right in our very own Defiance liquor store, DBC. So I'm really excited. I think this is the game changer. This is what makes it a little bit different than your typical.
It's kind of fun walking around the liquor store with your phone out, trying to find the picture of the thing that you're looking for. So.
Okay, so 3 ounces of gin, 1 ounce of vodka, a half ounce of Lillet Blanc. If you can't find it, which we weren't able to find for a while, you could also substitute this with Saint Germain, which is a liqueur. And if you're really hard pressed, any sweet white vermouth would probably do.
Yeah.
If you can find like Kochi, they have a sweet white vermouth that's very, very tasty. And then we just did lemon peel to garnish. So Jason, let's stop talking about it and be about it. Yeah. Cheers. Let's take a swig of this.
It's definitely a little dry.
Oh yeah.
That's really good. Well, I don't know where the sweet notes are coming from.
It's the Lillet Blanc. Yeah, I can. That's the thing. Actually, 3 ounces of gin, 1 ounce of vodka, then a half ounce of Lillet. That's what I'm tasting.
It's like strawberry-y.
Ooh, see, I don't get that.
I don't know what sweetness I'm getting.
I'm not sure what to equate it to. It is sweet. It's just, you know what? It just counters this would be a super dry drink without that.
Oh yeah,
it's interesting. I can't put my finger on what the sweetness is. This is gonna sound weird. It's a florally sweetness, and maybe that's the Nolit's in there too, because that's a more florally kind of gin.
Man, but that's really interesting. I didn't expect that, especially since there's, the serum that ruins all drinks included inside of this drink.
Yeah, the tater water is not taking over.
It's not.
Well, but that's kind of vodka's thing, and actually that's unfair because Tito's is not tater vodka; it's corn vodka.
It is.
So.
Anyway, maybe we're cheating a little bit here. Maybe that's the sweetness coming out.
The Lillet really reminds me of that Kochi sweet vermouth that we had before.
I remember cocktails. I'm going to smell this stuff.
Is that what you're tasting?
That is not what I expected it to smell like. I'm not going to lie. That's got to be the gin and this combined. It's got to be. Here, smell it by itself. It smells like wine. I mean, it smells like a regular white.
Oh
wine.
Yeah, it does. Like grapey.
Yeah. I mean, there's nothing. Nothing overly sweet. Now the Norlitz is like you said, very florally.
Your palate might be more refined than mine. It says on here, there's a recipe on the back, and they put strawberry as a garnish. So if there's some strawberry sweetness in there, that would probably complement that. Maybe that's what you're tasting.
Yeah,
I don't know.
It's okay if your palate's dead because of all the bourbon you drink.
Sometimes I fry it. This is pretty good. It's a pretty manly drink. I'd say this is not.
I think you should try it though. This is an easy one to make.
It is.
I mean, if you don't like it, just drink the bottle of wine.
By the way, I think this goes without mentioning it, but we shook this. We did not stir it.
Yeah, exactly.
All right, enough
lots
of that.
Ice, nice and cold.
We've talked way too much about things that are not finance related, so moving on.
Maybe this is our excitement about the I-bond topic. Maybe, I don't know.
Jason, what the heck is an I-bond? A series I-bond.
So this is a government bond.
Okay.
Right. Issued by the government, by the United States of America government.
A debt instrument.
A debt instrument that is designed to protect your purchasing power.
Okay.
And so what they mean
That's why it's Series I.
Correct.
I for inflation.
Yeah, I for inflation.
Okay.
So this is kind of like an inflation indexed bond. issued by the government.
So I hear inflation and bonds, and what I typically go to is tips.
Yeah, exactly. But those are
Treasury and inflation protected securities.
It's just a different type of bond. And I mean, the I bond typically is issued with a fixed interest rate of some sort, which happens to be 0 right now. And it's hedged, or I guess hedge. I don't know if hedge is it's indexed, I think is a better way of saying it, to the current inflationary environment that we're in. So,
which has been nil to speak of for the last 10 or 15 years, really.
Exactly. And since we are at 40-year highs around inflation, now current rate on an I bond issued up to October is 9.62%.
That's a lot.
It is. Now, big asterisks here, folks. So you can only put.
Well, hang on. Don't spoil it. Don't spoil it. Let's not go there yet. There is a limit. So I guess before we jump into that, let's clearing up what exactly a Series I bond is. So I brought up the Treasury inflation protected securities, the TIPS, which we see those sometimes as like a money market part of a portfolio, something like that. This is different because you can buy those on the secondary market. You can buy those in mutual funds and things of that nature.
Right, they're traded.
Yeah, and Series I bonds are issued directly to individuals.
Correct.
Like what if you worked at a bank, like we did at one point.
Right.
Probably the bonds that you're most familiar with would be those Series EE bonds.
EE bonds.
And if you were born in the 80s, you may have been gifted a Series EE bond from grandparents at some point, right? So this acts more like a Series EE bond, right? It's issued to an individual, and right now the only place to get them is on the Treasury's website. But
that's wrong.
Is it?
That's wrong.
Where else can you get it?
You can actually. So I had this question come up. I don't want to do it on the website. You have to get a form quadruple 8.
Okay. All right.
And you can get a paper.
But you can't walk into the bank and buy it like you could buy those EE bonds.
It has to come directly from the Treasury.
Okay.
Yes.
Yeah, no secondary market.
No secondary
the only place
market.
to sell it is back to them, right?
That is right. Okay. So, yep. So the denominations for a paper bond it's all very similar
similar to E-bonds.
Yeah, what an E-bond would be, 50, 100, 150.
E-bonds, we don't see these anymore because there's really no point. They have a fixed rate and issued at current rates over the last 10 or 15 years have been nil. I guess a few people out there still use them, but I always ask why.
Right. Very depressing.
Let's talk a little bit about how they work. I think we have an understanding of what they are.
Sure.
And the first thing that I have written down here is, how is that rate determined? So you mentioned right now the base rate on it is 0, but where's 9.62 coming in?
So it's based on the previous 6 months worth of inflation data. Now, I'm assuming they're using the CPI, Consumer Price Index. I'm assuming. But I guess I don't know that for sure.
Well, they tie everything else to that. That would make sense.
Yeah, and it's a variable rate, and then it's sounds like it's pretty much fixed. It is fixed for 6 months.
For 6 months, and then resets based on the inflation data again.
Yeah, so that's why there's kind of like, it seems like almost like a subscription period where you can buy it up to a date, and then they stop, and then they're probably going to reset the new issuance at a higher or
different
lower
rate. Yeah. So I think some of the draw to this is since it's retroactive, it's looking at the last 6 month period. You're cashing in on 9.62% inflation, let's say, even though inflation may be coming down now, right?
Right.
But in October, it's going to reset again.
Right.
So
exactly. And so the issuance of the current I bond subscription period is done in October.
Okay. So it's twice a year, October, and then what, March?
I think it is March. Yeah. Yep. So
okay. Yeah. So that's how the rate's determined, indexing basically based on inflation, and then it changes. This is I wrote down here the maturity. These are 30-year bonds, Jason.
They are, right.
So in our careers, we hear 30-year government bonds and we go, stay away, right?
Yeah. Although if I could get a fixed 9.62% for 30 years,
I think I'd be okay with that.
I might be signing up for a few of those.
Yeah.
But that's not how this works.
No. And I think that a lot of people say, why not I bonds? 9.62% on a 30-year bond. Why wouldn't you take that? Well, because in October, that rate's going to change.
It's going to change. And, it might stay in that range. But, CPI data that came out last month, it was down.
Was lower. Yep.
Yeah. And not a little bit. I mean, it was more than 0.5%. So
right.
It can fluctuate.
So you have a pretty good idea of where that bond's going to be, what it's going to be paying the next time around.
Right.
But I think that's some of the draw to this is, well, inflation's coming down and I can still get 9.6, yeah, for a little bit of time. So we talked a little bit about the maturity. There's kind of a redemption schedule with these too.
Right.
So you're buying a 30-year bond. You can't sell it within a year.
No.
Okay, so there's a caveat. Is it liquid? Yeah, there's some liquidity, but you can't sell it within a year.
So you're really locked up for 12 months here. It's not really 30 years.
So in everything that I read, there's after 5 years, there's no penalty to sell it back. Okay, right. So really, if kind of like you would look at a CD, right? No penalty if you hold it up to. If you redeem this or sell it back, in years 2 through 5, you're giving up 3 months worth of interest. Very similar to how a CD works.
Right. So you're giving up. You're not losing. You're not going backwards.
No, you're not losing.
Yeah, you're just giving up 3 months of interest.
Right.
Not too bad.
So they pay every 6 months, right? Whenever they reset. That's now you can choose how you take this, because one of the other things that I'll bring up with this is taxes.
Yep.
This is something that is exempt from state and municipal, but not federal income tax. However, there's some caveats. So another thing that might make this attractive is if, let's say you redeem one of these and you use it for qualified education expenses like college tuition or something,
right?
Then the interest can be completely, triple tax exempt, like muni bonds and things like that.
Exactly.
Yeah, there are some cases there where it is tax exempt, but when we're talking about 9.62%, remember that's not federally tax exempt either, like any treasury bonds typically. So here's the kicker, Jason, because so far these sound all right. And especially if you're looking at what the market's doing right now, it's a little choppy out there.
Right.
I mean, we've seen a good run back since the bottom, and I'll say bottom because I'm just assuming that we hit the bottom at some point. No, we could go the other way. We could continue to go further the other way, I guess.
Sure.
But I think a lot of people say, well, why would I jump into the market right now when it's so choppy, when I could park money for 9.62%?
Exactly.
That's great, but there are some limits to this, right?
Yeah.
So far, this sounds good. If I could park money for 9.62% for 6 months and let the market kind of figure itself out, why wouldn't I just move my whole portfolio, Jason?
Yeah, I mean, I think that's a conservative way of looking at this. Well, there is a limit. And so you can put $15,000 in these I bonds per individual, husband, wife, so that's $30,000 total. Mm-hmm. And there's another little caveat, $5,000 of which is only purchasable with your tax refund.
Yeah. So the limit's 10. Yeah. You could go to 15 if you take your tax refund and apply it towards one of these.
That's right. So it's even got a little hook there.
Yeah.
So 10
So
grand.
if you've done a good job with your withholdings and you don't have a big tax refund, you might be stuck at $10,000.
I mean, put your EA hat on for a minute. You're not going to let someone put $5,000 in extra withholdings.
Right. We're going to say this is ineffective tax planning here, right?
Exactly. Yeah. So it's really $10,000 per individual. And is that per issuance? I guess I don't know.
Per year.
Per year.
Yep.
So
you could buy a bunch of these. And the thought would be that over a long period of time, if inflation remains very high, maybe it would be a good investment. Although, well, I guess maybe this can bleed over into the next section.
Right.
Who do these benefit, and should you buy them?
Right.
Let's do that, because I want to continue my thought there. 9.62 sounds great, right? Because the bank isn't offering 9.62.
That's right.
New issue bonds aren't offering 9.62.
Nope.
Right? But this is all based on an index for inflation, which means everything else is costing you 9.62 essentially, right?
Correct. I mean, or, all the prices in the world have already adjusted to that point. So
let's say we could put all of our money into these I bonds. Let's just create a scenario.
Yep.
I could put everything that I wanted over the next so many years by purchasing 10 or 15,000 per person in my household, right? And I'm going to get 9% plus. For the next 30 years, you'd look back and say, well, I did pretty well. Did you? Did you, Jason?
Probably not. I mean, basically, it was a way to ensure that your rate of return in your investments were zero.
Mm-hmm. Treading water.
Right. And not even, barely. You're floating on your back with the water coming up around your nose. It's because inflation is so high, your purchasing power is being depleted so quickly.
Yeah.
And I get it. There's someone out there rolling their eyes right now going, oh, yeah, you're the market guy. But the market
you
went
guys
backwards.
are permables. Everything's going to be great. Yeah.
But, during a period of time where inflation is high, generally speaking, at least historically, and we did a bunch of this research this week,
Yep.
Markets sell. If you got cash, the years that followed heavy inflation numbers were shockingly well.
Yeah.
Well, shockingly. I mean, we were surprised.
You say shockingly well. Another word is coming to my mind, and I can't quite spit it out. It's astonishing. It is astonishing when you look at the years following, recession or high periods of inflation.
And we looked at several of them historically, and here we go. Here's a disclosure. The historical returns aren't necessarily indicative of future.
But like
returns.
Dave Ramsey always says, yeah, but that's the only thing that we can really base our decision off of, right?
Yeah, and so like looking at it, I think we were all kind of pleasantly surprised. Now, of course, it's always difficult to throw the dart at the timeline and say we're right here,
and definitely. So it's like trying to catch a falling knife.
Yeah, and it's not good. I have another metaphor for that. You ever seen those like videos online where they're like the dad says, "I'll put this credit card against the wall. You just have to catch it with your head."
Oh yeah. That's a good one.
Yeah, I think it's kind of similar. Like I do feel like I bang my head against the wall sometimes, so I kind of like that one better. But anyways, I think that we were surprised. There's a point where
and we do this for a living, by the way, and we were still surprised.
Yeah, and we're not saying that we're not in an economic slowdown, which is kind of by design. Inflation's very high right now. For us to continue at that particular number for that long, it is healthy. Actually it's detrimental to the economy. So I think I was just...
We've talked about this before. Sometimes recession is the cure.
Right.
It's kind of what the doctor ordered. We're trying to slow things down. Right. Exactly.
Which I hate the term, and I said it like 1,000 times this last 2 weeks. I hate the term that they keep using, the Fed and the Treasury Secretary. They keep saying, we need to navigate a soft landing. And I just want to scream like...
I think we're past that.
I think we flew over the runway a few times, guys. Like... So, the surprise, I think, is what came after that. You started to see what I'm going to call a significant decline in the inflationary read from, like in the 80s, we were talking like 13, 14% down to like 8. 8's still really high.
Historically high.
Yeah. And yet the market was like, oh, okay, we got this thing we're starting to wrangle it. Okay, it may not be in the fence we want it to be in, but it's getting close. And it was encouraging, is a better word, to look at what the narrative seems is just so negative right now.
Yeah. Well, and we've seen this too, where the market performance does not necessarily follow recession.
Right.
There are inflationary periods and recessionary periods where the market has done well, but usually, I mean, the market's going to react negatively at some point. Markets are usually trying to price things in where we're going to be at 6-12 months down the road, right? So if we look back on this scenario, and this is not us pontificating about what we think is going to happen with the market, I don't have a crystal ball and you don't either.
Right.
But just because the economy slows down doesn't always mean that the stock market follows. It could have been indicative of what happened the first 6 months of this year, really, pricing those things in.
It was already priced in. The market already responded.
I'm not watching it right now, but this conversation we're having, I'm sure the market's plummeting right now because of this conversation.
It was this morning. It was selling. So, but the reality is like any tool, any financial tool that's available to us, we should consider. Number one,
sure,
this is a part of any reasonably well-designed financial plan.
So let's talk about who this benefits and who it makes sense for, because I think, now you tell me what you think about this, because you had clients ask you about this. Do you think there was an unspoken like, hey, is this a substitute for what we're doing in the market?
No.
Okay.
It wasn't. It was mostly around, I'm going to buy a car in 2 years.
Okay.
I've been saving.
Yep.
I have 20 grand sitting here. It earns point depression and we need to just do something with this money, but I don't want to put it in the market because I'm going to spend it.
And we would tell you shouldn't put it in the market.
Absolutely. Right? And I know when someone says I'm going to buy a car in 2 years, what that means. It'll probably be 3.
Yep.
Okay. Yeah. I mean, that to me is a reasonable parking spot where you're at least not treading water. You're more than treading water. You're keeping your nose above the water. Okay.
Yeah.
And it's good. And I think this is kind of like in that emergency fund category for me. I think that's where it's useful.
Yeah, I think you nailed it, Jason. Because I think you could look at this, you could look at the return and say, well, wait a minute. If stocks, on average, let's say the S&P does around 10% and I can get 9.6 here, why wouldn't I do that with a government guaranteed bond, right?
I'm not going to disagree. I mean, I wouldn't disagree.
But again, we're looking at, years in a recovery, missing out on 20, 30, 40% in some cases,
That's
right?
right.
So is this a substitute for your stock portfolio?
Nope.
I think you nailed it right there. Who's this good for? Someone who's sitting on too much emergency money or that, sinking fund money that's earmarked for something in the next 1 to 5, even 5 as a stretch, right?
Yeah.
Down payment for a house, buying a car.
Exactly.
Kids going to school and, we didn't get on it. We don't have a 529, but here they're 16 years old and we got to put some money away. Those types of scenarios.
Absolutely.
So yeah, absolutely. I think like you said, is this a viable option? Yes.
Yep.
For a portion. Now they limit it anyway, so you're going to be limited to what you could put into something like this. But is it a substitute for traditional, good old-fashioned asset allocation and retirement accounts and things of that nature? No, I don't think so.
No, I don't think so either. I think it's just it's a convenient distraction. I think the part of this that gets me kind of ticked off is
a little bit TO'd.
Yeah. Especially after this drink. Now I'm getting TO'd. It's just got a component of fear.
Mm-hmm.
And I hate that part. It just ticks me off because statistically speaking, this 9.62% rate will not last.
Yeah.
But what will last is average market returns over a period of time.
Right.
And
you said it there.
That doesn't make a good headline.
The fear element, right? There's something there. And I think also the fear of missing out too.
Yeah.
People look at this and go, this is a great deal.
Yeah.
I think we have to stand back and say, is it really though? Because what these are designed to do is just pace inflation, keep your purchasing power the same. So are we really getting a good deal? If anything, folks, this should highlight what a bad deal you're getting at your bank and your cash accounts and your money markets and your CDs. Don't you agree?
Old-fashioned finance is brought to you by XYZ
Chase
local bank. No,
right.
You're right. It's depressing. I mean, certificates of depression at 3%.
I love that. This is the first I've heard that.
That is like bad, and point nothing is also bad. And
this is not a great deal. It just is showing how bad of a deal cash is right now.
Yeah, and don't get too wrapped up in the advertisements in the newspaper right now for 3% CDs. Like, don't do it. It's like, I feel like it's like I need to route cheetah.
In an average inflation year, 2 to 3%, a 3% CD is okay.
Totally.
We're not there. Well, no. I think there you have it, folks.
This was good. We went all over the place.
Bonds. bonds. No, you do yours.
Keep your day job.
This is my day job. All right, folks. Well, thanks for having a drink with us this week. It's time to close out the tab. If you have a question or a topic you want addressed on the Old Fashioned Finance podcast, be sure to email us at podcast@bluejfg.com. We'd love to hear from you. Don't forget to share the show with someone you love or just someone who needs a little money muddling themselves. You can stay up to date with the latest action by following us on Facebook. Old Fashioned Finance is brought to you by Blue Jay Financial Group. That's bluejfg.com. And produced by Podastery Studios. We've been your hosts, Caleb and Jason. Cheers. Blue Jay Financial Group, LLC. Blue Jay is a registered investment advisor registered with the state of Ohio. Registration does not imply a certain level of skill or training. The presence of this advertisement on this podcast shall not be directly or indirectly interpreted as a solicitation of investment advisory services to persons of another jurisdiction unless otherwise permitted by statute. Follow-up or individualized responses to a consumer in a particular state by Blue Jay and the rendering of personalized investment advice for compensation shall not be made without first complying with jurisdiction requirements or pursuant an applicable state exemption. All verbal and written consent on this presentation is for information purposes only. Opinions expressed herein are solely those of Blue Jay unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.
Yeah.
Yeah.
Ooh, we should drink
pretty
some more.
good.
I didn't finish that. That was heavy. Dude, you poked yourself in the eye.
Boy, that's
You're
strong.
a professional.